Thank you for joining us. I'm Gord Long. It's my pleasure to have with me this morning Charles Hugh Smith, well-known and very prolific writer on the web, who is the publisher of the well-followed website of2minds.com, longtime co-host with me here at Macro Analytics. Welcome, Charles.
Thank you, Gordon. Always a pleasure to do another program with you.
Well, this one we're doing as a podcast. Charles, let's just jump right in because we have a lot of slides here to go through. Follow on financialization and the path that we're on. And I wanted to maybe, this is part one of a couple that we need to do on what the results of financialization mean. What is happening now? We traced the roadmap there before of how we got to financialization. So I'm hoping that we can really go through that and try and explain some of the, in a series here, of what the problems are and what we're seeing unfolding right in front of us. Any comments before we begin, Charles?
Well, Gordon, I think the main context here is we're going to try to describe something that's relatively complicated, and it's not visible just in a surface like a TV news blurb or a headline, about corporate profits or debt. And so we're digging beneath the surface, and so it's going to take a little work to follow along, but it's going to be worth it because these are the core dynamics of the economy going forward.
Charles, let's just recap how we got here, which is kind of some of the basic materials we had in our previous shows and some of the stuff I put out to my subscribers. The core came from our level of social entitlements, promises, and commitments that governments, all the democratic governments have been making for a long time. And those entitlements are unfunded in the vast majority of cases. Poor governance, and the bottom line is it just drove government debt to GDP up to levels that historically we've never seen before, other than after or during a Great War, and even in many cases they're above that. And so what happened is, from that, financialization took over the investment of capital. That's the problem, is the reapplication of not just creating capital, which is wealth, but then how that capital is being used. That's the core of the problem with financialization, is how it's used, and we talked about that. And then what's happened is monetary policy, or what we've referred to here in previous shows quite a few years ago when we were talking about it, we called it monetary malpractice, and it has led to that. And that is their whole policies and practices, the macroprudential policy of financial repression, which was implemented to keep the debt from imploding. And now what we have is the debt now consumes most of the productive capital that is created. And that's what everybody needs to understand. That's the real core issue that we have. Comments there so far?
Yeah, I think what we're trying to describe here, Gordon, is the growing dominance of debt. In other words, we used to fund the government with taxes and it was pay as you go. Now we rely more and more on debt. And not just to fund government, the Pentagon and social welfare programs, but it's what we're going to dig into is here. Now corporations rely more on debt. Consumers rely more on debt. We're becoming an economy that relies almost totally on debt and the leverage that debt creates.
Exactly. We spent a lot of time on government debt. We spent a lot of time on consumer debt level. We haven't spent a lot of time on what's happened with corporate debt. And that's really what we want to talk about today as we zero in, as you point out. This growth in corporate debt is problematic because it underpins the consumer's ability to consume and ability to pay taxes, and the government's ability to fund itself and receive taxes. So if corporations can't make the profits, then the whole underpinning. So what happened to what's happening to cause problems there? Because the stock market's at historic levels. Apparently profits are great. So is there a problem? And I submit to you that's not the case. So it gets into what I'm saying here, what financialization means. To understand that and then we'll go into corporations, is that credit growth now drives economic growth. Liquidity flows, which is the application of the credit, is now drives asset price directions. And what people and everybody needs to appreciate is the government now attempts to control both. They're controlling credit, availability, and they've always had a finger in it there, and liquidity flows. And so the market is no longer the primary driver. That's not subtle. That's what's happening, and it has profound implications. You can call it creditism, fascism, that's what one time it was called, financialism, or any form of socialism, but I'll tell you it's certainly not capitalism, because capitalism is about savings that are invested into productive assets which produce savings, and therefore there's where we get the growth, and it leads to higher productivity, higher standards of living. And I know you've done some work saying the productivity's not there, which reinforces the problem we have. Today, credit, here's where the difference is, credit is created to produce consumption, which produces debt. It doesn't produce capital, it doesn't produce savings. And that in a nutshell is kind of like where we came from before in our conclusion, before I jump into what it's now meaning to corporations. Comments there, Charles?
Yeah, I think you've done an excellent job of summarizing the difference between the system we have and classical capitalism. So in the idea here is that capitalism distributes savings into the most productive parts, and the market will decide that and reward those investments that really boost productivity, because that also boosts profits, right? And it also boosts wages, because with higher productivity we get higher wages. Now we have stagnant wages and really phantom profits, which you're going to describe how that works. And so that's the difference. We have stagnant wages and phantom profits, and as you're going to go into how that works with debt for equity.
When capitalism's working positively, you get more for less. That's what happens when capitalism is a competition and the proper use of capital for productive assets. So you get more for less. When that doesn't happen and you bleed it out, what happens is you're forced to get less for more. And that's the beginnings of a socialization, doctrination that comes in, or at least capitalism not working. And that's what we have right now. And especially in an economy that eventually leads where you're consuming more than you produce. And clearly in the United States for quite some time, we've been consuming more than we produce, which leads to the acceleration of financialization of false profits. So let's talk about corporations, because what's been driving the market, Charles, as you well know more than anybody else, has been primarily buybacks. Literally over $1.2, $1.4 trillion of money, capital, has been bled out of profits by corporations to buy back their shares. That's what's been holding up the markets. Yes, it's the money to allow that to happen in terms of the economy has been flowing from the governments in terms of quantitative easing. That in itself is a discussion, but what's been underpinning of the market and the major stock moves has been this relentless pursuit of buybacks from corporations. Now, why are they doing this? Because the issue is that when you're in a low interest environment like we're in right now and have been since we started with quantitative easing, at least in the United States, is you get better use of money than if you were to use equity capital offerings to raise money. If you use debt, that is, versus equity, because you would only use your own money if you had opportunities. But because we have limited top line opportunities, we have excess capital capacity, underutilization right across the board, it's better to use debt versus equity offerings or buying back your shares, what I'm saying. And also there's tax treatment that are benefits on debt payments. So also in a low interest environment, you want to increase your leverage during this period of time, but you've got to make sure that you're capable if interest rates ever go up, that you can offset those higher interest rates, or you got yourself in a catch-22. That's why it's so critical in a low interest environment how you spent your capital, so that you have the earnings power later on. And that's we haven't been doing. And I'll show you one of the reasons we haven't. The perception, Charles, is that the reason that corporations have been doing that is because earnings per share look better. If you buy back your shares, there's less shares to go into falling profits or reduced profits. So and that's, it says, hey, therefore you've got a better earnings per share. But any kind of analyst, it's only the amateurs and brokers trying to sell something that could get away with that game. That's generally what people say. The corporations are the reason they're doing it. Yeah, they're doing that, and it makes sense. But that's not what's really driving. And comments on that before I get to the next slide?
Yeah, Gordon, I think we just to give a quick example, let's say we have a corporation with 1,000 shares of stock, and we go out and borrow a ton of money at a very low interest rate, and we buy back half of our shares. Now there's only 500 shares outstanding. Well, let's say we made we made a $1 a share when it was 1,000 shares. Well, now if we make the same profit, we've doubled our profit in terms of earnings per share. That looks stupendous. We've doubled our profits. And yet, as we're describing, that's a phantom increase, because the company is still earning the exact same net profit, but on an earnings per share basis, it looks like we've doubled it. And so, of course, the share price goes up. And as you point out here, that limits the takeovers, because we've boosted the price of the company considerably, and we've also created huge wealth for us executives, who now our stock options. We had 100,000 shares of stock options. Well, now that the stock price has doubled, we've made a tremendous amount of money, and yet the company is not producing any more sales or any more revenues or any more actual net profit. So there's a certain element of you don't want to say fraud, but it's not real. You can use whatever word you want. You can use phantom, fake, false. But it's not an actual increase in revenues or in net profit for the company, and yet it's benefiting insiders immensely.
It's working today, and then that because we're only looking at earnings per share. The vast majority of people, years ago, you couldn't have got away with that for more than a New York minute, because people would say, yeah, but you've increased your debt, so therefore the book value is out of line with your sales, your top line growth, revenues, and there are a series of ratios that we would all consistently look at to make sure that they all balance. But nobody talks about all those other ratios anymore. I never hear about them at all, but they're critical. And the biggest one is how much debt and how much leverage, and therefore the risk, are you putting on your books to get the earnings per share down because you're buying back your shares. And so the issue is that we're just not paying it. The investors aren't paying attention to what they used to pay attention to. And it's not up to Wall Street to tell anybody if they're just trying to sell and move shares. But the corporations, yes, the executives are making a lot of money and they really want the shares. There's no question about it. But they're also, they jumped on this immediately because the major reason to them is they want to reduce the dividend payout. Okay, so by buying back shares, and they only have, and they're going to pay out so much dividend, there's less money that they have to pay out now to get a higher level of yield if there's less shares. So, they concluded, they knew immediately when we were going into everybody chasing yield around the world as interest rates went down, the thing you really wanted to do to protect your company was to get your yield up. And if you look at stocks that are really doing well and held up, it's because people are buying them for the yield. Yes, the yield may be low, but relative to bonds are pretty attractive. But if you think the stock is going to be the same or go up between the yield and the capital gains, it's a no-brainer. But a lot of cases, you don't even care if the stock doesn't go up as long as it doesn't move. It just stays the same. The yield is more than attractive. And a lot of funds play the game where they actually strip the yield out, or the coupon, if you would, by buying derivatives and hedges that the stock goes up or down, primarily protected if it goes down, to stop them from losing that yield that they're trying to strip out. So it's getting this yield up, which means reducing the numbers of shares. And that's what you do in a low interest environment. And bonds are being used to, and bonds here's the really issue, are being used to fund the dividends in addition. So they're borrowing money that's now being paid out as dividends, which is the crux of the problem, because there's insufficient cash flows that are now coming in. This is a big problem. And they're forced to do this because they need their currency is their stock price. So they need their stock price up, otherwise somebody else leverages up and the takeover happens, and then immediately they're loaded down with even more debt. And also for them to fund potential acquisitions, if in a no-growth environment, you want to be able to creatively find growth. If you can't get it when you've got overcapacity and underutilization of your assets, and then of course executive bonuses. So there's not a subtle game, but there's another game that's going on which has driven these corporations to do that. Comments?
Well, Gordon, as your slide here, debt for equity, who makes the money? I think what one of our key points here is that debt is paid first. So if the company makes $1 million and it's borrowed $100 million and it's got 900,000 in debt, the stockholders, the shareholders, don't get that gross profit. That goes to pay the debt. And so as you're describing, they're loading themselves up with debt because those are the incentives that make sense in the economy as it is now. It makes no sense to risk money building a factory in the United States, because, that's risky. It might not pan out, or you might not have the margins you anticipated. So you just borrow a ton of money, you buy back your shares, and you play these financialization games. And so, but if profits decline, the debt has to get paid, or the company goes into default. So the shareholders are at risk in a way they don't really understand.
The issue today, Charles, in an era of financialization, who are the real owners? And the owners of the company are always people who have the equity. Well, equity means that there's a risk and a reward. Right now, I would argue the equity holders take all the risk and the reward is nothing. Debt holders are always paid first. Even if there's only minimal profits, they get paid. And they, in many cases, they can even be losing money, but they will. The debt holders will be paid. So if you're making 6% on the money that you've lent as a senior secured note holders, you don't care. Like, if they're making money, you're making your 6%, or you're making your money on your debt instruments if you sold them all the way down the capital structure, right to preferred secured shares, which are really quite popular also. So at the end of the day, the companies, the shareholder, where's he making any money? He's only hoping on stock appreciation. So the real owners, the ones taking no risk, are the debt holders. And try and go out and buy senior secured debt in any way. You come on. The banks are the only one that get that opportunity all the way down. So I would argue that in this era of financialization, true real ownership has shifted, and it's now the debt holders who own those companies. And we've seen this in that, private equity now owns or controls at least over 60%, and I've got numbers that show it higher, of the S&P 500. And the first thing they do when they take over is they load the balance sheet with debt that was all part of the takeover. So, and then you're going to say, well, who lended the money? Okay, and what I was just reading recently, a lot of the private equity guys now are unloading these companies, but the question is, well, who's still holding the debt? Because that debt's still being paid by these companies on the debt holders. So this whole game of private equity has changed the debt for equity game that's been going on. And a question that's been bothering me, and I have no proof of this, Charles, is where is the money being lent to buy all these bonds? Who's they're issuing the bonds, but who's buying all these bonds? To lend the money to? I can see why the corporations want to do it, but who's lending it? Obviously, when I look at the amount of unrepatriated offshore profits, all the corporations have got staggering billions and billions of dollars in profits that they haven't paid any taxes on that are offshore somewhere. Now, I know Trump and them are trying to get them tax advantage to bring it back. But Charles, if you were sitting with billions of dollars offshore in profit, what would you be doing with it? Leaving it in a bank account? Well, you'd have to invest it. What would you invest it in? Where would you invest it? Well, if you had an entity, well, wouldn't that entity say, well, maybe I should, and I'm Apple, and an entity of Apple that has an investment entity, maybe it buys Apple bonds. So all of a sudden, you could have entities buying back or buying your bonds, which is, if you could trace that circle through, this is one hell of a game. Does that make sense to you?
Right. It's a perpetual financialization machine, because you put your profits overseas, and you use that money to buy your own bonds.
And the bonds are then used to buy back shares and to pay out dividends. So the stock of the price goes up. And when the price goes up, what happens is you have more leverage. Look what happened, for example, Amazon when it bought Whole Foods. Amazon stock should have went down. Whole Foods should have went up. Whole Foods went up. Amazon stocks went up. So, and they didn't give them cash. Controller just printed more shares. So if you can play games like this with repatriated offshore profits, I'm speculating here, but I know if I was a CEO, it would have taken me about 5 minutes, 5 years ago to figure this one out. I'm not going to be sitting with $60 billion offshore trying to decide whether I'm going to buy, I don't know, some investment fund. I know where I want my money. I want my money right back in my company in some way. I'd be buying my own bonds. And you can do it as an offshore investment entity, right?
Right.
So this is the point is, all of this is because of financialization. These are the serious ramifications, potentially and obviously in some cases. So we're undermining the entire capitalist system. This is why it's so profound right now. This is the results of financialization. And if it's not scaring people, and they say, well, hell, the stock market's going up, they need to get frightened. This is problematic. Comments?
Exactly, Gordon. And what we need to describe here is, and I think if you read the slides, as a structure of incentives, then you're getting our message. In other words, if you are a CEO of a major U.S. corporation, you will be fired if you don't follow this financialization, because the incentive structure rewards that. You know, like, how do you maximize earnings per share? How do you maximize returns for investors? You're basically forced to follow this financialization roadmap we're describing here. You've got to go borrow as much money as you can at the lowest possible interest rate. You have to leave your profits overseas, and you have to play all these games. And if you don't, you didn't maximize value, and so you're fired. So it's a structural thing, you know.
A company that did play the games takes you over, and as soon as you're taken over, it loads more debt on you anyway.
Yeah, that's right.
So you know, you're sitting as a board of directors, and you know how the game's being played. You got to dance. You just have no choice but to get up and dance. And the government policies have forced boards of directors to dance to this tune. And, you know, going back to how we started at the beginnings, you know, capitalism is about savings, that is, profits being reinvested into productive assets. You know, why that is key is it results in increasing workers' productivity. But if we're not increasing worker productivity, which we're not, and you've put out a number of papers showing that historically, you know, when that goes up, those profits are shared with the workers to some degree. In a lot of cases, significantly, when there's shortages of real workers and you want to grow. Well, when I asked somebody the other day whether they thought the average increases were 2%, they busted up laughing. He said they didn't know anybody who got a 2% annual increase in so long they forgot there were such things. And yet, if I asked them what inflation was, nobody would say it was under 2%. So we're losing ground because there's productivity. And the money is not being shared with the workers. The problem with that, and I'm not trying to be a socialist here, is if that's not happening, you don't get increased standards of living. You don't get increased standards of living all of a sudden corporate profits, you're killing the golden goose that drives the economy. And that's the giant sucking sound of corporate profits that are really just being pulled right out of the economy and not into investment in productive assets. That's a bigger issue than just whether they're buying back their shares. It's what it really means with this lack of true investment. Comments?
I think you've summed it up real well here, Gordon. You write that capital being pulled from the hands of those who produce, and it's being shifted to those who don't produce. And so we're not really producing any more goods and services as a result of all these financialization games. What's happening is the wealth of the nation is being transferred into the hands of this relatively small financial elite who benefits from these games. And so the benefits are no longer flowing from, as you say, to productivity, and then through productivity to the wage earners who are actually the foundation of the economy. And so what we really end up with is, as you describe it here, are zombie corporations. They're not generating any more goods and services or paying higher wages. They're basically zombies going forward, paying out these financialization profits.
Charles, people don't understand that 72% of all U.S. businesses now are not profitable. And that's because the vast majority are small businesses that are not profitable, can't stay alive. That's not my number, 72%. 9% of all European firms right now can't even cover their interest charges on their debts that they've accumulated. Their profits don't even cover the interest payments. And so you say, well, how can this be? And that's because all the debt is just rolled over. So they're really, in many cases, they should be bankrupt. But they don't, because we roll over the debt. Because there's more money in rolling over the debt and stripping more capital out of the companies. So they're effectively transferring even the assets of buildings in one way or another to the debt holders. It's a giant sucking sound that's just sucking all of the wealth into a very small number of hands. And you've done a lot of work on the inequality to show where the top 10%, top 5, and amount of wealth they're creating versus where the bottom 80% are going. And they're going in completely opposite directions. And this is why, as we look at this.
Exactly.
And over the last 10 years, as it shows here, S&P 500 corporations have returned more money to shareholders via share buybacks and dividends than they actually earned. Think about that. That's how blatant in the magnitude this is. So, whatever you want to call it, Charles, it isn't capitalism that we have in it. We have something else. And that's the result of that's what financialization means to the corporations right now.
Right. No, this is just a shocking chart when you think about it, that you can pay out more than you've actually earned, and that is that supposed to be sustainable? And of course we know it's not. And so I think my closing comment would be, you've described the way this works, and then we go, why is it like this? And we go back to the Federal Reserve and other central bank policies, which have specifically been set up to keep zombie corporations alive, right? Because in a real open market, companies that are no longer succeeding are bought up, or they're closed. They default, and then they're liquidated. And so that, of course, disrupts things. And so that's no longer allowed. We lower interest rates. We push a lot of credit out there so that every zombie corporation can always roll over, as you say, their crushing debt into a new loan, and often at a lower interest rate, right? So they get another lease on life. And so what we've got is, my analogy is, financialization leads to like a forest that we don't allow any fires, no brush fires, nothing to clear the deadwood. And now we have an economy that, thanks to financialization, is loaded with deadwood. And so, and in other words, we never allow any brush fires anymore because those disrupt things. You know, people might get laid off, or you know, markets might be discombobulated for a few days or something. So that's out. So now we keep every corporation alive with debt. And so eventually the forest fire, you know, a lightning strike hits, and eventually there's a conflagration that you can't control. And that's what financialization is ultimately leading to. You know, all this debt's going to be consumed and destroyed, and no one will be able to roll it over.
We have so much malinvestment out there, and we're so terrified of layoffs that when the banks reach the point when they won't even, or the financial institutions won't lend any more money to these players and roll it over because they see no other assets that can effectively be stripped out of this debt pyramid, out of a productive asset. Then what happens is the governments step in because they can't have the layoffs that would come with a bankruptcy and subsidize or bail them out in some way. Most recently saw the automotive. We see no bankruptcies which are natural and a healthy part of the economy. And especially when we're in this massive amount of change brought on by the internet technologies, where there's Schumpeter's creative destruction, there should be. It's healthy to see a lot of bankruptcies being taken because of the advent of new technologies. We don't even see that. We've got to keep the old ones alive. And so that's why this whole thing of zombie corporations has come into fruition. And that is, as you point out, a massive problem. We have to wrap, Charles. I hope we weren't too complicated to our listeners here today, but I thought it was something that I don't think I hear a lot of people talking about and explaining what's going on here that I personally felt needed to be. Any closing comments you'd like to make?
Just that I think I'm really glad we discussed this because it's really important to understand the mechanisms and the incentives built into financialization and why it's not sustainable and why it's just boosting income and wealth inequality, which then creates the social disruptions and disorders that we've discussed in previous programs. So it's all connected, but this is the foundation we have to understand.
In part two, Charles, if this is scary, we're going to talk about something that's even more scary, which now the governments are going to be forced to do to keep this whole game financialization going, and now the trap they're now in, and why, in fact, we may not see a market collapse that should have happened. Eventually, yes, but in the near term. Because of what they will do in this trap. So we'll do that in part two. Charles, I hope you have a great stay in Hawaii, and I guess maybe the next time we talk to you next month, you'll be back in California?
Yeah, that's right.
Talk to you then?
Okay, thanks so much, Gordon.
Talk to you. Bye.
Bye-bye.